Yeah, so let's take a look at the S&P chart. And the S&P today looks like it just closed down just very slightly on the day, or basically flat. But basically, you're at a point where you're going to get these bigger bounces. But notice how the trajectory of the market has now shifted to lower highs and lower lows. So this is clearly telling us that there's this kind of mountaintop in the market, and we're now starting to curl over. And if you think about it, it makes a lot of sense because the Federal Reserve was printing all the way up. I mean, basically, in all fairness, since 2009, even before that, they've been printing and stimulating. We had QE, QE1, QE2, QE2.5, and all the way up to the COVID massive stimulus. And if you look at the balance sheet of the Fed, by the way, and the amount of money in the system from when COVID began, it is like a vertical line up. It's scary how much money was just created there. But the bottom line is, with inflation at 8-9%, you have to realize that the markets were inflated. Cryptocurrency was inflated because of the Fed, and now that's being deflated. So in the very least, I'm looking at a market on the S&P that has to come back to this 3,400 level, which is that former COVID high. That's assuming no recession. Right. So again, if you're saying, OK, the Fed is going to magically create a soft landing here, I don't believe that. But if you think in that determination, then in the very least, we need to come back to this level. If we get a recession, which is in my book for late 2022, early 2023, now you're talking about maybe seeing even more downside. I could see this low end right here. There's a trend line. You can see only COVID, the panic of COVID pierced it. Otherwise, you have this perfect trend line to these lows. And that would be my next downside target, which is right around 3,000 on the S&P 500. So we're talking like 20% lower potentially at bare minimum if we get into a little bit of a recession by late this year, early next year. So again, I hate to be a bear in this scenario, but in all fairness, everyone said don't fight the Fed. And that was when we were in a bull market, right? And it was what everyone said. And we heard it every which way. Well, you kind of have to say, okay, well, now don't fight the Fed. Well, what does that mean? Well, it means that they're pulling out the money and they want the stock market to come down. What they're trying to do is make people bring in the amount of money they have, or they have less money, which then will make them spend less, which will then bring down prices. And again, obviously oil coming down will help that as well, but they're really trying to get inflation down to a reasonable level. They've said 2%. They're not going to get it back to 2%, folks. The genie's out of the bottle. My guess is they'll get it to 4%, and then it's going to be sticky between 4 and 5%. And then when you have a recession, which is inevitable, even if they do a soft landing, you're eventually going to have a recession. That's just how cycles work. Well, guess what? They're going to say, 4% inflation, but 10% unemployment or 15% unemployment. Let's start printing again, right? So they're going to start printing again. And that's where, in my opinion, Bitcoin really starts to have its day in the sun. The next big leg up starts at that point. Whether or not stocks will react positively, we'll have to see, because I do worry that the recession then creates a drop in earnings, and then you have to reevaluate the markets. But ultimately, Bitcoin, I think when the Fed kicks in those printing presses again, that's where the next bull market starts.
Do you see the same situation for precious metals? Are they going to make the move when the Fed pivots?
Yeah, so I think my guess is we've already created, or we already have a breakout on gold, right? So if you look at this trend line here, this was your high in 2020. You had about a year and a half of consolidation, and then you finally broke out here, and now you've retraced. You've actually hit the scene of the crime, which is the retrace line. That's very normal in charts, and now you're kind of hovering here. In general, gold is think about it. Gold is like the sloth, right? We know sloths move really, really slow. It's just a really mature asset, so it takes a long time to move. But I do think that it's slowly going to inch up, take out the highs here, and then be off to the races. Because again, I think slowly the markets are going to realize, investors are going to realize that inflation is not going back to 2%. The Fed has let the genie out of the bottle here. The Fed is not going to be easily able to kind of control the downward move in the economy, which likely means recession. It means fear. It means stocks aren't going to be the place to be as much anymore. And I think gold is an underinvested asset for a lot of hedge fund managers. Very, very underinvested, because it doesn't get them the big returns that the Fed was able to generate by printing money in stocks like Tesla and all these other names. And so you're going to see at some point a rotation into gold, which should do very, very well. And again, just look to the 1970s if you want to see gold performing. The chart from 2020, or I should say from 2018 down here to 2020, and then this consolidation and the breakout almost picture perfect to the 1970s into the late 70s. And gold went up 9 times, I think, in the late 70s, not 9x. I don't think it'll do that this time because, again, it's obviously a lot higher. But I do think, I mean, you could be talking about a $5,000 per price gold price by 2025.
So what you're saying is when the stock market is selling off because the Fed is tightening, investors will look towards gold because stocks aren't giving any return?
Yeah, and I think fund managers will start to recognize, in addition to that you have a new scenario where inflation is not going away, right? So everyone's kind of in the camp, all right, Fed's going to aggressively tighten. It's going to bring back inflation back to 2%. It's all going to go back to the way it was for the past 20 years. I'm not buying that. You have wage. I think one of the biggest. So it's a great thing for people to make more money, but it also has an impact on inflation. And when companies are trying to hire workers and they're not getting anyone for $12 an hour, so they have to offer $20 an hour or $25 an hour, that's massive wage inflation that then has to be passed along to consumers in the terms of higher prices. So, the business doesn't say, well, let's raise prices by 100% because we have to raise wages by 100%. What they do is they say, let's raise prices this year 10 or 15%, next year 10 or 15%. And you see this longer kind of inflationary pressure because of a rise in wages. So that's my guess, is that that's what you're going to see in terms of interest rates, inflation, and all these other things. It's going to be a longer term impact.
And we did actually just see Jerome Powell, the chairman of the Fed, make his testimony today, and he stressed, the importance of bringing down inflation. But as you mentioned, I don't see how anybody can actually think that the Fed raising rates by the amount that they have been and plan to do is actually going to bring down inflation. I mean, if you look at what happened back in the 1980s with that inflation, they had to bring rates to double digits to actually make inflation come down.
Yeah, and I mean, think about that. I mean, we have a 3.3 10-year, give or take, and look at the markets freaking out. I mean, you're seeing the housing market just screech to a halt because taking out a loan on a house now is so expensive with home prices going where they have. So, I mean, there's already a major impact because of a 3% plus 10-year. I mean, I can't even imagine a 10% 10-year. But yeah, you're right. So I think oil coming down will help. In general, because we know oil is so pervasive, but overall, it's when you look at food, it's also the labor costs. People picking apples or this and that are going to cause those raises, and that's not. You don't see people's wages dropping back down. Like, you don't go to $20 an hour and then your boss comes back and says, well, inflation's back down, we're going to drop you back to $10 an hour. It doesn't happen that way.
Definitely. And could we, before we let you go, could we have you analyze silver for us? What do you see happening in the silver market?
Silver continues to be one of the trickier ones in the near term to analyze. And again, the overall longer term pattern is still bullish. So you have this low pivot to this high pivot. And then for the last 2+ years, we've just chopped sideways. We're at the lower range. The reason why it's a little trickier is because not only is it a store of safety, which is great, like it's a goldish type play, but it's also industrial, right? So if you see a massive slowdown in the global economy, there's less demand for silver, and it kind of offsets that security of being in something like a gold. So I think overall,